Hey everybody, this is Greg Gossett from Gossett Training and Mentoring. How you doing? Thank you so much for coming and visiting me and watching my weekend review podcast. In this podcast, the format is as follows. First of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back and look at all the trades that I made last week, both on the daily and the weekly time frames. We're going to talk about when I entered the trade, why I entered the trade, which strategy, which setup I was using. I use 5 different setups. And then most importantly, we're going to talk about how I'm going to manage the trade going forward, whether the trade goes in my direction or does not go in my direction. Generally when I look at a trade setup, I want to look for some kind of level that is rejected. I want to position size correctly. I want to place an emergency stop so that I know in the worst case scenario how much I'm going to lose. And then I'm going to place a much closer end of day stop so that if I'm wrong, most likely and hopefully I am wrong small. We're also going to talk about how I position size for the trade based upon the current volatility of that particular market. We're going to talk about taking partial profits if the trade goes in my direction. We're going to talk about if we get to my trailing stop level, then my trailing stop rules go into place. So, there's a lot to trading. It's very important to look for multiple confluences, combinations of setups, not just one. Ideally 2, 3, 4, as many as you can get. It's going to make the trade more likely that you're going to have a profit. Although, regardless of how many setups and confluences and combinations of indicators that you have, doesn't mean you're going to have a profitable trade. It just helps add some points to giving you a better chance of having a profitable trade. So I've been trading for 28 years, and these multiple confluences and combinations of indicators are really important to line up. All right, so we'll talk about when I entered, why I entered, how I'm going to manage the trade going forward. After that, we are going to switch and we're going to talk a little bit about trader psychology. Always the most important skill in trading is the ability to create a plan based upon good trading principles and then how to follow that plan. It's very easy to, when you're just back testing, to go, okay, I would have stayed in here and I would have gotten out here. But it's difficult because your emotions get amplified either to, if you have a loss, oh, I should get out. Well, is it to the point to where you wanted to get out, or do you get out early? Can't tell you how many times in my trading career that I've gotten out before my stop has been hit, and then magically it turns around and I'm out, right? And so it's important to follow your rules, because you never know what's going to happen in this market, but you have to know exactly what you are going to do, regardless of whether it goes up or it goes down. And that's basically having a process that you follow, and following your process is based upon your psychology. So we'll talk a little bit about trader psychology. Always important for me and helpful for me to teach it, and I hope that it is helpful for you. After that, we are going to come back and we're going to look at some potential setups that I am looking for myself next week, both on the daily and the weekly time frames. They're not there yet, because if they're at those levels or they had triggered certain price action, I would have already been in them. So it's nice on a Saturday. Actually, I do this Friday night. I go through all my charts, both on the daily and the weeklies, and I say, okay, they're not where they need to be. Where do they need to be? Then I mark those levels. So I just have them handy for the week. And then if they get to those levels and they have the right confluences and combinations of indicators lining up, then I potentially take the trade. Wait for the trade, wait before you enter for the price to get to where you see some kind of level rejected, or also to the upside. If there's some momentum to the upside that's showing you that it should be going up, wait for it to get there. I think a lot of traders, they get impulsive. They don't wait for the levels to activate before they take the trade. And you will be amazed if you just identify the levels on the weekend, on multiple time frames. If you wait for that particular market to get to that level and reject it, you'll be amazed how much more profitable you will be in trading. So I'm going to show you what I'm looking for both on the daily and the weekly charts. It was a crazy week last week, lots of volatility, lots of up, lots of down. October is one of those months, historically, from a seasonality standpoint, where there's a lot of volatility, and it has not disappointed so far. But we've had some good trades. I had some losing trades, but in trading, it's okay to have a great big win, obviously, right? Duh. But it's also okay to have a small win. And I'll show you something where I had a small win. It's also okay to have a break even trade. A break even trade is really a sign of a mature trader, where you can actually go, okay, it got to a level, it came back to a level, I'm out. It's okay to have small losses, and I'll show you some small losses that I had as well. It's totally fine. You're going to have them. But what you really want to stay away from are large losses. Large losses are the ones that will affect your account, really affect your account negatively, and more importantly, affect your emotional account, right? Because we have a financial account, we have an emotional account. And if you let trades turn into big losses, one, they're very hard to overcome, and two, they really can destabilize you psychologically. So staying away from big losses, both psychologically and financially, are very important. All right. So, but you'll see from my trades, I've had some big wins. I had some small wins. I had actually had some break even trades. I had some small losses. But if I'm doing my job right, then you're not going to see a lot of big losses in my trades. All right. So hopefully this will be helpful. So let's get started. First of all, I'm going to run the U.S. legal disclaimer. It takes about 40 seconds, and I will be right back. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, here we go. Let's take a look at all the trades that I made last week. Now, I do trade 5 different trading approaches. So not every trade is going to be using the same approach. And I do have a lot of rules, and the rules that I have are very specific. There's definitely a reason that I have every single rule. So if you're new to the channel, you may go, boy, there's a lot of rules here, but they're there for a reason. And by the way, if you're interested in improving your trading, if you'd like to study with me one-on-one, I do offer a private one-on-one stock trading program. 15 total hours. Each session is 3 hours, and we have 5 of them. I will teach you step by step exactly to trade like I do. I've been trading for 28 years. I've been teaching for many years. I've taught people from all over the world, from absolute beginners to hedge fund managers and everything in between. So if you're interested in learning the skill of trading, just send me an email. The email is the link of this YouTube video, and we can start to chat about that. But it's a skill that you will learn and have the rest of your life. And I think the very best way to do this is one-on-one with your instructor, and that's why I offer these courses. So if you're interested, please contact me. Okay, let's get started. AMD. Well, AMD has been a really good trade so far. I did enter AMD all the way back here on the 25th of September at 96.50. Now, why did I take the trade? Well, you see the 200-day moving average, the black line. This is a very important level that large financial institutions and savvy traders key their trades off of for a good risk to reward ratio. Now, on the particular day that I took the trade, you can see during the day it went below the 200 and then closed back above the 200. That is a valid signal just by itself. In addition to that, I talk about confluences, combinations of indicators lining up. We also had a V1. Here's bar 1. Bar 2 goes below bar 1's low, closes above bar 1's close, giving me a V1 also a rejection of the 200-day moving average. So I position size, and when I position size, it's very easy. And this is, position sizing is such an important part of trading, everyone. When the market's volatile, you want to buy less shares. When it's less volatile, you can buy more shares. But real quickly, how I do this is it's all based upon the value of your account. Let's just take a hypothetical $100,000 account. So if I have a $100,000 account, I times that by 1%. How much is my maximum allowed loss? It's $1,000. If I had $50,000, 1% would be 500. If I had $25,000, 1% would be 250. About $1,000,000 account, it'd be 10,000, right? So all you do is take 1% of your account value, and we'll use hypothetical $100,000 here, which is $1,000. You divide it by the value of the 2 ATR. And ATR means average true range. That is, in the last 20 days, what's the average true range, the average. So that's based upon how much it went up or went down, essentially volatility. And I divide that number into my maximum allowed loss, divided by 7.48. That shows me that I'm going to buy 133.6 shares. I can't buy a fraction of a share, so I'll just round up to 134 shares. That is the appropriate amount of shares to buy based upon a $100,000 account, 1% maximum allowed loss divided by the value of the 2 ATR. So I'm going to buy 134 shares. Okay, so I buy 134 shares. Now I have two stops. I have my emergency stop, which is all the way down here from my entry. And how much is that? It's the 748. So I just take my entry minus whatever the ATR was when I enter the trade, 748, and I put it down here. So if I have 134 shares and it moves down $7.48, how much have I lost? I've lost $1,000. So I know pretty much where, there are situations where it could gap further down, but most of the time, 2 ATRs below is going to give you a very good level. So if it moves 2 ATRs below, then I'm going to just get out of the trade and I've lost my $1,000. It's 1% of my total capital. It's not fun, but it's not going to destroy my account. I can withstand that. I can come back from that. Okay, but that only happens, hitting your emergency stop is only going to happen about 5% of the time, in my experience. 95% of the time, when you have a loss, it's going to be your end of day stop. Well, my emergency stop's 2 ATRs below for my entry. My end of day stop is generally, why did I get in the trade? Well, I got in the trade because it had an intraday rejection of the 200-day moving average and closed back above. Now I have the support of the 200 below me. So my end of day stop on this trade would simply be the opposite of that. If it closed back below the 200-day moving average, I would simply be out for a small loss, much less than a $1,000 loss, because my emergency stop is all the way down here. Makes sense? Okay, so I see the trade, intraday rejection of the 200-day moving average, bonus points on top. We have a V1, I position size, I place my emergency stop 2 ATRs below. My end of day stop is going to be a close below the 200-day moving average. These are all defensive moves. Now, let's talk about some profit. I have an orange line up here, exactly 1.5 ATRs above. So emergency stops 2 ATRs below. My trailing stop level is 1.5. That means that, so I take my entry price, add 1.5 ATRs to the top of that. This is my trailing stop level. If I get to the trailing stop level, now I go into trailing stop mode, which simply means if I have a close below a previous bar's low, I will get out of half. So when I move up a certain amount, 1.5, now I go into trailing stop level to reduce my risk so it doesn't have to come all the way back to the 200-day moving average. Now, in addition to that, I also take partial profits each day if we move the value of a 0.45 ATR from the previous bar's close. So I entered here. Next day we came down. You can see that during the day we tested the 200-day moving average, but we closed above. Everything I do is based upon the end of the day for my end of day stops. If my emergency stops hit, well, I just get out of that immediately. I do not wait for the end of the day. But my end of day stops is based upon the closing price, because the closing price is the most important price of the day. Okay, so I got long here, 96.50. The next day, it didn't move up 0.45 ATRs from the previous bar's close, so I did not take any profits. And then we tested the 200. It kept me in the trade. The next day, I did take some profits because I took the close. I added 0.45 ATRs as a partial profit level, and it moved up. It did hit one. The next day, moved up again. I hit two profit targets. I took the close. I added the 0.45 ATR to it. That's my first profit target. Take my first profit target. I add 0.45 ATRs to it again. That becomes my second. And then I take my second and I add 0.45 ATRs to it again. That becomes my third. So I always have 3 limit orders in the market for the next day based upon the previous bar's close as potential profits. Okay, so on this move here, I took some profits. On this big move here, I hit 2 profit targets. And in addition to that, I also got to trailing stop level, 1.5 ATRs for my entry. Now, if I have a close below a previous bar's low, since I've reached trailing stop level, I will get out of half. That happened here on the 3rd of October. We closed below the previous bar's close. After reaching trailing stop level, I got out of half of the remaining shares that I have for a 3.51% gain. Now I have fewer shares. I've reduced my position size. And next day we moved up again, took some more profits off. I took 10% of whatever shares that I had remaining in each profit target. Next day kind of moved sideways. And then Friday was a big up day, hit 2 more profit targets. So I really like to take profits, partial profits, not all, but partial profits, because it keeps reducing my position size. It locks in profits that the market can't take away from me, and it reduces my overall risk. So, so far, the remaining shares that I have on this trade up 9.93%. Pretty good trade. Netflix. All right. I took Netflix on Thursday, which was October 5th. Why? Well, 200-day moving average should give you a clue to what I wanted here. During the day, we went below the 200-day moving average, closed above it. We also went below the 30 RSI during the day, closed above it. So I position size. I placed my emergency stop 2 ATRs below. Where's my end of day stop? Well, why did I take the trade? Because it rejected the 200-day moving average. Therefore, in the future, if it closes even slightly, even 1 penny below the 200, I will just get out for a small loss. And then the orange line here is my 1.5 ATR trailing stop level above. So if it gets to this point now, I will go into trailing stop mode. We opened up down because of the non-farm payrolls report, but the market quickly reversed back up, and I hit 2 profit targets. So I took 20% of my position off, locked it in, reduced my position size. We are not yet at trailing stop level, but once we do, if I have a close below a previous bar's low, I will get out of half. So nice entry. And good thing I waited to the close, right? That's important. This particular trade up 2.48%. Not bad on the first day. Verizon. Verizon was a trade that I took on Friday at the close. Why did I take this trade? Looks like it's really down. It is. But it rejected some key levels. You can see the RSI right now is 31.42. During the day, it went below the 30 RSI, but it was strong enough to close back above the 30 RSI. In addition to that, my confluence and combination of indicators was, do you see the negative third Keltner channel? Do you see how during the day we went below it, but yet closed back above it? Now that negative third ATR channel is support underneath me. And the market already told me that there were no more sellers under this 30 RSI level. I mean, in the future on Monday, there certainly could be, but it doesn't matter because I've already position sized correctly. I know where my emergency stop's going to be. I know where my end of day stop. Look, we're at 31.42. On Monday, if it closes at 29.99, I simply get out. That's it. And then here's my 1.5 ATR trailing stop level. So this particular trade in the money slightly, not a lot, but up 2.91%. All right, so those are my open daily trades. Let's go to the trades that I got out of last week. All right, these are the cues. I did take the cues on the 27th at 354.80. During the day, we went under the 30 RSI, but closed back above it. We also have a V1 signal. Bar 1, bar 2 goes under the low of bar 1, closes above bar 1's close. That was my combination of signals. And by the way, if you would like to learn more about V1s or V2s, they're a very important part of my trading. I have a video on my YouTube channel, and I think it's in the link of this description as well, V1, V2 entries. Totally free. Go and watch it. I think they'll be very helpful for you because they are a very large part of my trading, especially for the confluence part of the entry. So the main entry was the under 30 over 30, but it improved the trade by having the V1 as well. So I entered here 354.80. Of course, I position size correctly. I placed my emergency stop 2 ATRs below. I placed my trailing stop level 1.5 ATRs above. The next day, we moved up nicely. I took some profits off. That's key, that I took some profits off at a profitable level. The next day, moved up again, hit some profit targets, reduced my position, locked those in, and on this particular day, I got to trailing stop level. Now, if I take an these are the rules only for under 30 over 30 entries. If I take an under 30 over 30 entry and it does get to my trailing stop level, I have a rule that in the future now, if it goes back to my entry point, I simply get out of the trade. And you can see this limited me, but a lot of times in under 30 over 30, if you go 1.5 ATRs above your entry and then it goes back to your entry point, it's a very bad sign most of the time, not all the time, as you can see here. So on this particular day, because it got to because it moved 1.5 ATR trailing stop and then it got back to my entry point, I got out of the remaining shares at break even. Now, in hindsight, was that a good idea? No, it wasn't, because we moved up. But still, it was a profitable trade. Why was it a profitable trade if I got out at break even? Because I took the partial profits when I had them. So anyway, this trade ended up being positive because of the partial trades, but the bulk of the shares I got out at break even. But remember, getting out at break even is allowed using good trading principles. XLV. All right. Well, this was a kind of a bummer as well. I got into XLV. Let's see. Here on the 2nd of August. Why? Well, we went under 30 during the day, over 30 during the day. We rejected the negative third ATR channel. I got in at 127.92. I position sized. I placed my emergency stop 2 ATRs below. My end of day stop, why did I get in the trade? Under 30 over 30. So the very next day, it closed under 30 RSI. So I had to get out of the trade for a small loss. Remember, small losses are acceptable. 0.42 ATR. I'm sorry, 0.42% loss on the trade. The next day it went up. I did not get back in the under 30 over 30. And then it moved up nicely. So, but that happens, right? It happens. But the main thing in trading is to manage that risk and keep those losses small. And I could have got back in. I just didn't. But this was a loss of 0.42%. SPY. I got into SPY on the 3rd of October. I got into SPY here on the 26th of September, and under 30 over 30. I got in at 425.90. The next day it went below 30 but closed back above the 30 RSI. Here's my 1.5 ATR trailing stop level up here. Next day moved up, which was nice, took some profits off. Next day moved up again, took some profits off, did not get to my trailing stop level. So when it got back to my entry point, I did not get out because it did not get there. And then I did exit the trade here on the 3rd of October for a loss of 1.2%. 0.01%. Did not get back in on the next day when it went back over 30. So this was a loss of 1.01%, but still a small loss, not anywhere near my trailing stop level. All right, so just to recap on the daily trades, the remaining shares I have on AMD up 9.93%, Netflix up 2.48%, Verizon up 2.29%. The closed out trades, the Qs break even on the remaining shares, XLV loss of 0.42%, SPY loss of 1.01%. So they're not all winners, but you know what can you divine from what I just showed you? I've had some big wins, right? The AMD. I've had some medium wins, the Netflix. I've had some break-even trades, the Qs, and I had some small losses on the XLV and the SPY. That's proper trading. Big wins, fine. Small wins, fine. Break-even trades, fine. Small losses, fine. But you can see I haven't had any large losses, and that's the key. Excuse me. Okay, let's go to the weekly trades. All right, weekly trade I took here on Apple at the on Friday. Beautiful return to value V2. This is one of the strategies that I teach in my course, one of my favorite strategies at all. You can see the two green lines here. This is anywhere in here is called the value zone. You don't want to buy above value. You want to buy in value, sell above value, or buy below value, sell in value. Well, of course, Apple had this huge, gigantic run up. Don't want to buy up here. And obviously, that was not a good idea to buy up there. But we did return to the value zone. We had some sideways motion. And here we have a V2. A V2 consists of three bars. Bar 1, bar 2 goes below bar 1's low, washes it out. And then bar 3 closes above bar 1's close. Beautiful return to value, sideways motion, V2 entry. And it's on Apple. You know, Apple historically is really good place to buy the dip, but you need the signal, and this is the signal. So I did get long here, 175.30. I position size correctly. I placed my emergency stop 2 ATRs below, so I know exactly what my emergency stop's going to be. Now, on a return to on a V1 or a V2 entry, your end of day stop is simply a close below halfway of the washout bar. This was the washout bar. Day 1, day 2 washed out, or in other words, went below day 1's low, and then day 3 or bar 3 closes above bar 1's close. So I entered here 175.30, emergency stop down here, 1.5 ATR trailing stop level here. In the future now, my end of week stop, because this is a weekly trade, if it closes below halfway of the washout bar, then I will get out. So from a Fibonacci standpoint, high to the low, 50% is an important level. If the trade's going to work, it should not close back below there. If it does, I simply get out. All right, so this particular trade on the weekly, currently up 1.18%. Alibaba. Alibaba had a beautiful return to value V1. I didn't buy it there. I actually missed it. But the last week, you can see halfway the washout bar. This is the key level, halfway the washout bar. So if I was in this V1, if I get a close below halfway the washout bar, I get out. Well, the next week, it went below halfway the washout bar and then closed back above it. So I got in a legitimate trade still at a little bit better price. So I got in at 86.40. This week, again, we went below halfway of the washout bar, but it kept me in because it closed back above. So you can see how the two bars tested the halfway, closed above, tested the halfway, closed back above. So this particular trade is down a little bit. It's down about 0.36%, not too bad. But going forward now in the future, if I close below this $86 level, it closed at 86.09, so it stayed above. But if it closes below $86, that is my end of day stop. But of course, I have my emergency stop down here as well. So we'll see what happens. So that trade down 0.3%, 6%. Gold Gold is another weekly trade that I took on Friday. Why? Well, black line should give you give you a clue of what I was looking for. This is a key level that the market during the week went below it but closed back above it. In addition to that, we have the negative third Keltner channel. 92% of prices tend to stop going down, move sideways, or go up at this level. So that was a confluence of signals. The intra-week rejection of the 200-day moving average and the intra-week rejection of the negative third ATR channel. So I position sized. I bought here 169.70, exactly what it is, 169.70, so totally break even. I position size. I place my emergency stop 2 ATRs below. I have my trailing stop level 1.5 ATRs above, and my end of week stop here will simply be a close below the 200-day moving average. So this one's completely break even. And then XLF, I've been in this trade for a while, and if I ever tell you that I've been in a trade for a while, it means that it's a positive trade, because I'm not going to let a trade turn into a big loss. The only time I'm going to stick in it is if I am positive on the trade. Well, I bought XLF all the way back here March 24th. Why? Do you see the purple line? This is the 250-week moving average. During the week, it went below it and then closed back above it. I got in here at 30.71. I position size. I placed my emergency stop 2 ATRs below. I have my 1.5 ATR trailing stop level above. And of course, each week, if it moves up, I take partial profits. Next week, moved up. I took some partial profits. Next week, didn't do much. Next week, moved up again, took more partial profits. Now I'm in trailing stop mode, meaning if I have a close below a previous bar's low in the future, I will get out of half. We had a move down, but we never closed below a previous bar's low until this week here on the 23rd of June. We had our first close below a previous bar's low after rejecting or after getting to trailing stop level. I locked in half for a 6.4% gain. Then we had a month and a half of just moving up, which was great because I took profits here, I took profits here, I took profits right here at the top. Then we started to move down again. And then, of course, we've had the big sell-off in the market, but it did not, the remaining shares did not close below the 250. So the remaining shares that I have on this trade here, up 7.08%. All right, so real quick recap on the weekly trades. Sorry. Apple up 1.18%. BABA down 0.36%. Gold completely break even. XLF up 7.08%. So again, at risk of saying this too much, but it's very important, you'll see from my trades, you'll see large gains, you'll see some small gains, you'll see some break-even trades. You obviously will see some small losses, but you see how we haven't seen any large losses? That's the key, everyone. And if you repeat that process over and over and over, that's how you make money in trading. All right, so yeah, not a bad week, everything considered, and really glad I had AMD because that was a monster trade, and Netflix not too bad and kept the losses small. So those are the trades from last week. So let's talk a little bit about trader psychology. This is my good friend Stephen Burns. You can follow Stephen on Twitter or X at S. Joseph Burns. Steve is a great trader. He's a great coach. He's a great mentor, a great author. He has many great trading books. I studied under Steve and learned a lot. So really appreciative of Steve. So please follow him. But let's see what Steve has to say. Don't focus on your profits and losses. Focus on your signals. If you have an edge, profits will take care of themselves. And it's very true. And I've used this analogy a lot, but let's talk about casinos. Blackjack, roulette, craps, baccarat, slot machines. You know, every gambling game in a casino is based upon the casino having an edge. It doesn't mean they're going to win every hand of blackjack. It doesn't mean they're going to win every roll of the ball in roulette. But over time, they're going to win more than they lose. They're not going to win every hand, every roll of the dice, just like we are not going to win every trade. But if you have an edge, that's why he says, if you have an edge, profits will take care of yourself. Well, what's an edge? Well, an edge means that, let's take a bounce, intraday rejection to the 200-day moving average. Not everyone is going to have an edge. But if you take 100 trades, you're going to have more gains off of that 200, depending on the stock or the market, than you are going to have losses. And then you have to manage those gains, as I've showed you and how I manage them. But if you have a loss, meaning it closes below the 200, just get out for a small loss. So basically, if you're at a key level and it rejects it and closes below, just get out. Yeah, small loss. So what? But over time, you're going to have trades that hold above that 200 and keep moving up and up and up and up and up, so that you can have those large gains. You need to have those large gains to pay for all those little losses. But all the strategies that I teach are based upon having the potential for a large gain, but if you're wrong, having a small loss. And that is an edge. And in all the 5 different strategies that I teach, they're all based upon this principle. They all have an edge. So don't focus on your profit and losses. Focus on your signals. Just follow those signals. And if they tell you to get out, get out. Doesn't mean if you think, well, I think it's going up. It doesn't matter. Just follow the proper trading setup that you have, and you have to make sure it has an edge, right? And so that's really what it is. Don't focus on your profit and losses. Focus on those signals. If you have an edge, profits will take care of themselves, just like a casino. They don't win every hand. They don't win every roll of the dice, every throw of the roll of the ball or throw of the dice, but they have a mathematical edge. So given time, they will make money. It's the exact same with trading. So hopefully this is helpful to kind of put it in that way. And please follow Steve at S. Joseph Burns. All right. As discussed, everyone, let's look at the trades that I am looking at next week. Cameco, CCJ. This is a setup I don't talk a lot about. We don't have a lot of them lately, but ICT. You can take a look at ICT on YouTube. It's a great setup. Like I said, I know I don't talk about this a lot, but this is a perfect setup. This is a fair value gap. I am looking for a short on CCJ if we get up into this red zone. Why this red zone? Well, here you have a level. We ran the level of liquidity. Here, we come below the first swing low. This changes the market structure to the downside. All right. We have a level. The level gets run. We take out the first swing low in an emphatic way, obviously. This changes the market structure. This is now in a downward market structure. So, you've heard the saying, buy dips in an uptrend, sell rallies or rips buy dips in an uptrend, sell rallies in a downtrend. Well, we are now in a downtrend. So if we get back into this level here, it's called a fair value gap. There's a gap here between the low of this bar and the high of this bar. This was only sell side liquidity. We've never tested this level. So if we come back to this level, I don't know if we will. If we do, though, I will get short in this level. I will position size correctly. I'll place my emergency stop 2 ATRs above, and my end of day stop will simply be a close above this high, because if we close above this high, then we change the market structure back to a positive market structure. So I don't know if this is going to happen. And if you've been watching this channel a while, you've heard me talk a little bit about fair value gaps, not very often, but this is so perfect that I really want to tell you about it. So if we do get back into this level, somewhere between 40.70 and 39.80, and what I do, if it gets here anywhere in it, I'll go a third. If it gets to the half of this red zone, I'll add another third. If it gets to the top here, I'll add my full position, and then my stop will be simply a close above this high. These are very strong signals, but again, I'm not going to get involved with it. It may just come to here and roll back over, but I do feel pretty comfortable that this CCJ is going to head back down because of this massive structure change to the downside. But anywhere in this red section here between 40.70 and 39.80, I will be starting to position for a short. Walt Disney, this is the exact opposite. On Cameco, look, we had liquidity, we ran it to the top, and then we viciously changed market structure to the downside. So I'll be looking to short this rally. Walt Disney is the opposite. Here we had a low. Here we ran the low. We ran the liquidity to the downside. And on Friday, we took out the first swing high, giving us a structure change to the upside. You can kind of tell something's changed on Walt Disney from down, 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 down to up. So level of liquidity. Here we ran the liquidity. Here we change market structure by taking out this swing high dramatically. So if and only if Walt Disney comes back into this bullish fair value gap, the low of this bar, the high of this bar, I've highlighted in green here. If and only if Walt Disney, DIS, gets back here, that will be my sweet spot to buy. Because again, buy rallies in an uptrend. Friday changed the structure of Disney from a downtrend to an uptrend. I don't want to chase it up here. It's a little chasey, but very, very likely if it comes back into this fair value gap, then we will head back up. Doesn't have to. Of course, I have to have my emergency stop 2 ATRs below, and where will my stop be? Well, my stop will be a close below this low, because then it will change the market structure back to a bearish market structure. So I'm looking to buy partially as soon as it touches. If it gets in the middle, I'll add another third. If it gets to the bottom, I'll add another third. But anywhere between 80.50 and 79.80 is where I'll be looking to get long Disney. Pfizer. Okay, well, Pfizer right now is nothing, but you see the two green lines. This is the value zone. I'm looking for a higher low V1 or V2 in the value zone. One of my favorite setups, and the rule is that we first need to close below the green line, the bottom of the value zone. Well, we certainly did this. Then we need to rally into the value zone, which we have in between the green lines. And now we need a bit of a pullback. And then I'll be looking for a higher low V1, V2 because, let's just say Monday we go below Friday's low and then reverse back above Friday's high. That will be a higher low V1. This low will be higher than this low, and that will give me a good risk to reward ratio for a V1 or a V2. MACD is also green. So I don't want to chase it here. I'm looking for the market to go below a previous bar's low and then reverse back up. It'll say, oops, nope, don't want to do that. Reverse back up, and higher low V1s, V2s tend to trend. Dips tend to go down, bounce, and then come back down, but higher lows tend to trend. So next week I will be looking for, it's kind of hard for me to say because I don't know how this is going to play out, but for example, on Monday, if we were to go below Friday's low, wash it out by a quarter ATR, and then close back above, then it will give me a good structure, a good risk to reward structure, and a good trigger to enter the trade. It doesn't mean it's going to be a positive trade, but I have the levels there that give me a good risk to reward ratio. And risk to reward ratio is everything in trading. And again, if you'd like to learn more about V1s, V2s, just go to my YouTube channel, look for V1s, V2s, and the link is in this description of the YouTube channel as well. VIX. VIX's volatility. Well, VIX, I am looking for a buy. Why? Back to fair value gaps. Here we have a level of liquidity. We ran it. We went strongly above the swing high. Now we are in a bullish market structure. So I'm waiting for any pullback into the gap. The gap is anywhere from the low here to the high here. This is the gap. I've highlighted it in green. You can see it's already worked because look at this bar here. See how we poked our head back into the gap? And what did it do from there? It immediately rallied. So this is what I'm looking for, a pullback into the fair value gap. If it gets to the high of the gap, I'll add a third. If it gets to the medium or the halfway, I'll add another third. If it gets to the bottom, I'll add another third, and then my stop would be the first close below the first swing low, which would be here. Don't know if it's going to get there. If it doesn't get there, I'm not going to mess with it. But if it does get there, we are in a bullish market structure, so I'm looking to buy a dip. Exxon. Oof. Talk about market structure change. Look, here we have a high level of liquidity. We ran the high, and then on this bar here, it closed below the first swing low. This is in a bearish market right now, obviously. If it were to rally back up between here and here, the highest fair value gap, I would short here. I don't think it's going to do that, but who knows? If it does, I would get short. But what I'm looking for at this point, even though we're in a downward trend, I am looking for a buy at a key level. Well, the key level to me is this 300-day moving average. If we look back in time, did it respect it the last time? It certainly did. Look, it closed above, closed below for a small loss. But if you got back in here, look at the run that you had in Exxon. So if I'm looking at a rejection, intraday rejection, a bounce, a close under, close over the 300, I like to look back in the past and go, was that level respected last time? It certainly was. So that's what I'm looking for, everyone. I am looking for a rejection of this 300-day moving average next week. If it just keeps moving up, well, fine. I just missed the trade. But if we come back down, back test that 300, either intraday, a bounce, or a close under, close over, I will consider getting long at the 300-day moving average. Now, it's possible that all of these daily trades that I'm looking at here, Cameco, Walt Disney, Pfizer, VIX, Exxon, it's possible, it's within the realm of possibilities, that these could all trigger on the same day. Does that mean I would take them all? No, I generally only take one trade per time frame, and I have to narrow it down to the best. So if these all triggered for some reason, I would really narrow it down to one. How would I do that? Which one has the most confluence of signals? Which one has the best risk to reward ratio? Which one looks better on the higher time frame? Right? These are all the things that I teach in my class, how to narrow down. If you have 5 trades that look good, how to narrow it down to the best one. And I have found that taking one trade per time frame, the best one really improves your results. So real quick recap, Cameco, I'm looking for a rally back up into the fair value gap to short. Walt Disney, I'm looking for a pullback into the bullish fair value gap to buy. Pfizer, I'm looking for a potential higher low V1, V2 next week. VIX, looking for a pullback into the fair value gap to buy. And ExxonMobil, simply looking for some kind of rejection next week of the 300-day moving average. Let's head to the weeklies. Hey, and by the way, everyone, if you are enjoying this podcast, if you're finding some value from it, I really would appreciate if you could just hit the thumbs up button, maybe subscribe to the channel. It really will help the channel out with YouTube's algorithm, because if you get likes, and then YouTube goes, okay, there's some valuable content here, and then they'll show the video more. So if you are finding some value in this today, if you could just take a second or two to hit the thumbs up button, I would really appreciate it. All right, these are weekly bars. So weekly bars close on Fridays. So next Friday, if and only if next Friday we rejected the 200-week moving average on Home Depot, I would consider getting in the trade. Again, I look in the past, was the 200-week respected? Well, it certainly was. Right here, we touched it almost to the penny, literally to the penny, and then had a huge rally. Does it mean it's going to happen this time? No, it does not. But that's what I'm looking for on Home Depot. Either a bounce at the 200 that gives me a good risk to reward ratio, a intra-week rejection of the 200-week would also get me in the trade and give me a good structure, good risk to reward structure to base a long entry off. Coca-Cola, KO, woof. Look at this, everyone. Pretty brutal here. Now, this is a huge, huge bar. What I'm looking for at this point, I don't think I would take this with a close over the 200 just because of the violent nature to the downside, but I would consider a if I had a good risk to reward ratio of the 250. You can see during the week we've rallied off the low. It almost got to the 250. So there were some buyers here. Doesn't mean they're going to be buyers next time, but I would certainly consider it. Now, in 2 weeks, we have earnings. I never hold through earnings. So if I do get in, it may be a short 1 week kind of trade for me. But whether it's on the dailies or the weeklies, I never hold through earnings. It's one of the best ways to lose a lot of money quickly. Yes, of course, it's a way to make a lot of money quickly too. But as traders, our first responsibility is capital preservation. So I always have to look at the potential risks that outweigh the potential gains. And by holding through earnings, you're really putting yourself at jeopardy to get surprised to the downside. So if I'm in this trade, if we reject the 250, I would consider taking the trade. But if I do take the trade, I would get out before earnings. Silver, SLV. Well, 300 comes to mind here. You can see we got very close to the 300. We did not touch it. Here, we did not touch it either, all the way back here on the 10th of March. But, metals have really gotten beaten up here lately. At some point, they will find a level which respects, but I'm looking for silver SLV potential bounce at the 300 SMA on the weekly or intra-week rejection of the 300. SSO, which is double leverage SPY, is definitely something I'm looking at. We had a nice little rally on the weeklies and a V1. Bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. But I'm looking here at the 200-week moving average on the SSO. Don't know if it's going to get there. If it doesn't get there, I won't take the trade. Let's look in the past. Did it respect it? Respected it here. Respected it here. Will it respect it in the future? I don't know. But it will give me a good level, a good line in the sand to base my trade off. But don't know if it's going to get there. Kind of hope it doesn't, right? Because I'm long other stuff. But it does. That would be a good risk to reward ratio with a bounce or intra-week rejection of the 200. And then last but not least, bonds. Well, bonds have been in the news a lot. This is TLT. The more this goes down, the more interest rates go up. And so we have had a historic move down on bonds. Look at this, everyone. Incredible. It's in the news a lot. It's on a lot of magazine covers. There's massive volume down here. Everyone's bearish on bonds. But me, that makes me interested in getting long, right? But I have to have a level. Now, I usually talk about 30 RSI levels. We are way below the 30. We're at a 2165. A 20 RSI level, a rejection of the 20 RSI level is also valid, everyone. So that is what I am looking for next week on TLT. I would not take a 20 RSI on a company stock because that could be going out of business. On something like gold or bonds or oil, I would consider a rejection of the 20 RSI because they are not going out of business no matter what. TLT bonds are not going out of business. So right now we're at a 2165 RSI. Next week, if we bounce at the 20 RSI, we almost did it this week, or we go below the 20 and then close back above the 20, then I would consider getting long TLT. All right, so real quick recap. Home Depot, some kind of rejection of the 200-week moving average. Coca-Cola, some kind of rejection of the 250-week moving average. Silver, rejection of the 300-week moving average. SSO, potential rejection of the 200-week moving average. And bonds, rejection of the 20 RSI. So, at the beginning of the podcast, I mentioned that I teach private lessons. If you're interested, please reach out to me. I know you'll be happy you did. I have taught so many people all over the world, and they have learned a lot and become a lot better traders. So my email is in the link in the description. If you like online courses, I have a great, very affordable online course on udemy.com. The link is in the description. I teach you step by step how to teach or how to trade the deep dip buy stock trading strategy that I've developed. I've sold so many of those around the world, gotten so many good reviews and feedback, and it's so affordable. It's only like $12 or $15 on Udemy. I don't teach you all 5 of the trading approaches that I use in that video, just the one, but that one is a great one, and it's a really good way to get started for a very small amount of money. And the link's in the description. Again, if you like today's podcast, I would appreciate if you could hit the thumbs up button. It really helps build the channel. And most importantly, everyone, please try to go out and do something nice for someone today. Just one nice, kind act of kindness. Really, if everyone did that every day, it would just make the world a better place. And if I could ask one more thing, if you try to go out and do one nice thing for an animal today as well as a human, that would also really make the world a better place. I grew up with so many animals. They were my best friends growing up, and they certainly appreciate acts of kindness just like we humans do. All right, so one nice random act of kindness to a human, one nice random act to a animal, and it's going to be good for them, and it's going to be good for you. So I hope this was helpful, everyone. It's been a quite volatile month this week. And, I just read some news that there's some war with Israel and Hamas going on, and horrible to see that. And that will probably affect the market next week, I would imagine. But go out, do your best every day on your trading. Get yourself a good plan. Use good trading principles. Follow your plan. And if you do that, you'll be surprised over time what you can do with trading. But I appreciate you being here. I appreciate you spending your time out of your weekend, and I hope you have a good rest of your weekend. And God willing, next week we'll come back. We'll see how my trades did, and we'll see what this crazy market did. But if you have any comments or questions, feel free to put them in the comment section below, and I will do my best to get back to them. So thanks, everyone. Appreciate you being here. And on the way out, I have to run the full U.S. legal disclaimer. Thanks a lot, everyone. Enjoy the rest of your weekend. Bye-bye.
U.S. government required disclaimer. Futures and Forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.